So many people don't know that your Social Security benefit in retirement may be taxable. And that seems to not sit right with a lot of people when you tell them that. Because a lot of people are under the impression that they've paid taxes their whole life. They shouldn't pay it now in retirement. But, unfortunately, that's not the case. So I wanted to explain how your Social Security benefit may be taxable in retirement. And your Social Security taxation is driven by your other income, which we are going to go over here in just one second. So this is the number that matters. It's your combined income, and this is the formula on how you get there. You have your AGI, your adjusted gross income, plus your non-taxable interest, which is going to be things like municipal bonds, things of that nature, plus half of your Social Security benefit. So if you get 20,000 a year in Social Security benefits, it's going to be based on 10,000 because that's half of 20, which gives you your combined income number. And so your planning point is withdrawals, wages, interest, dividends, capital gains, and pensions can all be brought into this formula and push your combined income into taxable territory. So these are the federal tax thresholds. So this is going to be, so you take your combined income, you look at your filing status, you take your combined income, and then compare it to the taxable portion that the IRS deems taxable. So if you file single, head of household, and your combined income is 25,000 or less, you don't get taxed on any of your portion. So you have 0% taxable income. If you are single, head of household, and your combined income is 25,000 to 34,000, you can be taxed up to 50%. And then single head of household over 34,000, you can be taxed up to 85% of your Social Security benefit. And then if we go down to married filing jointly, 32,000 or less, it's going to be a little bit more because you're married and filing jointly. So 32,000 or less, 0%. 32 to 44,000, up to 50% taxable, and over 44,000, you can be taxed up to 85% on that. So the common misunderstanding in this. So when you tell people 85% of your Social Security benefit can be taxed, they say, "Oh my gosh, you're going to take 85% of my money." No, we're not going to do that. No, not we. I'm not the IRS. But they're not going to do that. They're not going to take 85% of your check. 85% of your check is the taxable portion, which they can tax on, if that makes sense. So for simple math, if you made $100, they could only tax you on $85 of that $100. So up to 85% taxable means the tax of your 85% of your ordinary income tax rate. It's not withheld dollar for dollar. So it doesn't mean that 85% of the check disappears. So a simple example. So your Social Security benefit is 40,000, and let's just say you have an IRA or pension income of 30,000 as well. So you would take 30,000 plus half of your Social Security benefits, like we talked about at the beginning, equals 50,000 total for combined income. Because $50,000 is above the married filing jointly threshold of 44,000, you could be taxed up to 85% of your Social Security benefit in this example. So the planning takeaway for this. Your IRA 401k distributions can raise taxable income. They can. That's why we have to plan for this. 2, your investment income. Interest, dividends, and gains can affect the formula as well. And work and pension income can definitely increase that amount as well. So a good retirement income plan coordinates everything. It brings Social Security, taxes, withdrawals, investments, and healthcare costs. Brings it all together so we can create a good, complete plan for your retirement. This this page was supposed to say questions, but it doesn't. So if you guys